This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance. Welcome to the Luxembourg Fundcast. Before we continue, we'd like to mention that the Luxembourg Fundcast is created and produced by Bertrand Mariot, a regulatory lawyer qualified as avocat à la cour in Luxembourg and Paris. The mission of this podcast is to bring clear, free, and reliable information sourced from official references that are carefully curated and continually updated, and refined through high-standard, evolving prompt and context engineering on Luxembourg's financial regulation and investment funds to professionals and anyone interested in the Luxembourg Financial Center. Today we are doing a deep dive into, what is basically the strategic blueprint for the entire Luxembourg Financial Center. We're talking about the CSSF annual report for 2024. Now, it was published back on August 28, 2025, but the timing for our chat today is, I think, really important.
We're speaking on December 5, 2025, and this is a moment when these huge regulatory frameworks, D-Dore, CR3, are either fully live or the deadlines are demanding immediate action. Okay, let's unpack this, because this report, it's so much more than just a list of last year's statistics. I was struck by the tone, actually. It's surprisingly stark, strategic, almost geopolitical right from the very first page. It almost reads like a manifesto.
It really does. What's fascinating is how the conversation is elevated immediately. I mean, when you have a financial regulator starting its report by talking about multilateralism being questioned, the fragmentation of the global order,
And the rise of the BRICS nations.
Exactly, pointing out that these nations now represent 3.5 billion inhabitants. What they're signaling is that regulatory strategy is now intertwined with continental security strategy.
That's a huge shift in thinking, isn't it?
Yeah.
So why does this geopolitical instability, matter directly to a fund manager in Luxembourg?
Well, it creates this sense of existential urgency for Europe to act internally. The CSSF draws a straight line from this instability to Europe's massive financing problem. We're facing an estimated gap of over 1,000 billion euros annually.
Wow.
Just to fund what they call the dual transition, that's sustainability and digitalization, while at the same time we have to strengthen our defense.
And government budgets can't cover that gap alone. So mobilizing private capital is no longer just about economic growth. You're saying it's being framed as a matter of continental security.
Precisely. And that's why the push for the Savings and Investment Union, the SIU, is so high up the agenda. It's directly targeting this enormous pool of capital, something like 11 trillion euros, that Europeans just have sitting in cash deposits. The mission is to get that cash working in productive European assets. It's about strategic autonomy.
And the tool for that, the practical instrument, is this Finance Europe initiative. Luxembourg was one of the key players behind this, right?
It was, and it's essentially a labeling regime. It's designed to make sure that when this capital is mobilized, it actually stays within the EU or EEA.
The requirements are quite strict, as I understand it.
They are. If you want this label for your fund, you have to commit to at least a 70% allocation in UEA assets. And it's about patient capital, so there's a mandatory minimum 5-year holding period for investors.
And the incentives are then set at the national level.
Yes, mostly tax-based to really attract that kind of long-term investment.
And tying this all back to competitiveness, the regulator made a really strong statement, I thought, about eliminating so-called gold plating.
This is a really fundamental point. Gold plating, is this tendency for national governments to add their own extra layers of rules on top of EU directives.
Which creates friction.
A lot of friction. So the CSSF's commitment to eliminating it signals a real drive for a pure, harmonized application of EU law. The whole goal is to cut costs and make Europe truly competitive on a global scale.
So that's the macro picture. Let's move into the engine room now, the fund industry itself. Almost 6,000 billion euros in net assets. And one of the biggest operational shifts in the report is this completely new constitution for handling administrative errors.
Oh, this is critical. We're talking about Circular CSSF 24856. It went live on January 1st, 2025, and it totally replaces the old Circular 0277. And this is a profound philosophical shift. The regulator is moving away from a system of, let's say, tolerance for minor errors
to a strict principle of what they call restoration.
Exactly. Restoration.
What does that mean in practice for someone on the operational side?
It means the fund and every single investor who was affected must be put back in the exact financial position they would have been in if the error had never occurred.
That sounds expensive.
It can be. Think about the operational impact. Legacy service agreements, they all have liability caps, right? Maybe 2 or 3 times the annual fees. But the cost of restoring a fund after a major NAV error could be astronomical, far more than those caps. So under 200-48526, those traditional indemnity clauses are now seriously challenged. The liability caps could be effectively useless for a regulatory breach.
So every investment manager, every service provider has to completely reassess their risk.
Completely. And this isn't just a theoretical exercise. The report says the CSSF got over 1,500 error declarations in 2024.
So the volume is there.
It is. And to manage it, the regulator is mandating digitalization. The old manual Excel uploads for reporting errors are gone. Now, compliance managers have to use the CSF's eDesk portal, or for higher volumes, an API that uses the S3 protocol. This has been a requirement since January 1st. It means your NAV compliance is now tied directly to your IT infrastructure.
Beyond that general rule, it gets really interesting when you see the CSSF getting very specific about certain asset classes, for instance, LDI funds.
Yes, this came out of the liquidity crisis in the UK pension market a few years back. The CSSF brought in hard macroprudential measures on July 29, 2024. So now, any GBP-denominated LDI fund based here has to maintain a yield buffer, a big one. It has to be able to withstand a 300 basis point jump in interest rates.
It's a defense mechanism against market shock.
A crucial one, yes. And it's formalized under Article 25 of the AIFMD, so it requires constant monitoring and documentation.
And we saw a similar move in real estate, which, well, had a tough year. Commercial transaction volumes down by 45%.
And the big concern there is the liquidity mismatch, especially in open-ended funds. When redemption requests spike and the market freezes, funds have to use their liquidity tools, redemption deferrals or gates.
Right.
So in July 2024, the CSS stepped in. They brought in a mandatory quarterly notification system. IFMs now have to report every single time they use one of these gates.
So it's not just about paperwork.
Not at all. It's forcing IFMs to proactively stress test these tools. And it gives the regulator real-time data to spot any systemic liquidity stress building up across the market.
Okay, let's switch gears. Let's talk about the digital agenda, the CSSF 5.0 strategy, and of course the big one, DORA.
DORA, the Digital Operational Resilience Act. Fully applicable since January 17th, 2025. I mean, the regulatory clock is ticking very, very loudly for everyone. The core obligations are clear. You need a complete register of all your ICT third-party arrangements. There's a new eDesk process for reporting major ICT incidents. And for the big players, the significant entities, you have mandatory threat-led penetration testing, TLPT.
That third-party register, that must be a massive job, considering how much the industry relies on external IT providers.
It is. And it creates what you could call a compliance cascade. Think about the support PFS entities.
The professionals of the financial sector.
The ones who provide the IT backbone. There are 61 of them, according to the report. Now, they are not directly classified as financial entities under DORA.
What?
But for a bank to meet its DORA obligations, its contract with that support PFS must be DORA compliant. This commercial pressure effectively forces the support PFS to meet DORA standards anyway. The requirement just cascades down the supply chain.
And what about on the banking side? The final stage of Basel III is now in place through CRR3 and CRD6.
Yes, most of those rules have been active since January 1st. The big global change is the output floor, which basically limits how much benefit banks can get from their own internal risk models. It sets a baseline for capital.
But there was a very specific local measure mentioned for the housing market.
Yes, a really interesting example of targeted easing. Luxembourg has kept a temporary derogation going until June 30th, 2025. It lets banks go over the 80% loan-to-value limit for some buy-to-let credits. It's capped at 10% of their annual production, but it was designed to inject some much-needed liquidity into a residential property market that had, well, largely frozen over.
Moving on to sustainable finance. The report really seems to confirm that the era of self-labeling is over. We're in the accountability era now.
Absolutely. The regulatory muscle is definitely there. You have Circular CSSF 24863, which puts the ESMA guidelines on fund names into practice. It's a strict mandate. If you use ESG or sustainability in your fund's name, then at least 80% of your assets have to be demonstrably aligned with those characteristics.
And the deadline for existing funds was May 2025, which I know caused a huge rush of prospectus updates.
It was a massive high-pressure cycle for everyone involved.
And this demand for accurate ESG data, it isn't just about disclosure anymore, is it? There's a direct link to tax now.
A very direct link. If a fund can prove it's highly aligned with the EU taxonomy, so it meets these very strict environmental criteria, it can get a reduced tax abondement. It can drop as low as 0.01%. So suddenly, having accurate, verifiable data isn't a compliance headache. It's a direct way to boost investor returns.
Let's talk about enforcement. Where is the regulator really showing its teeth? The AML data was interesting.
It was. The CSSF handed out 12 big fines for AML breaches, but the really critical part was the thematic review on proliferation financing, or PF. What they found was that many IFMs were good at screening the names of sanctioned people, but they were failing to screen their assets.
Can you give us a practical example of what that asset screening looks like?
Sure. It means looking at the actual underlying assets in the fund for what are called dual-use goods.
Things with both commercial and military applications.
Exactly. High-precision sensors, certain chemicals, advanced electronics. Your compliance framework now has to go way beyond just checking a name against a list.
And we also saw some very severe fines for administrative failures. The report mentioned a fine of 152,100 euros for a specialized PFS.
Yes, for failing to set up the central electronic data retrieval system. That fine sends a clear signal. Foundational infrastructure, the ability to pull up essential AML KYC data immediately, is non-negotiable.
The regulator sees it as a core operational weakness.
An existential one. And they're getting smarter with their intelligence. 174 whistleblowing reports in 2024, and 26% of them were about internal governance failures. The internal enemy, so to speak, is now a primary source of regulatory intelligence.
Let's circle back to costs. With this density of new regulation, DORA, MICA, all the ESG updates, it must be changing how compliance services are priced.
It's the end of the fixed fee compliance era, without a doubt. The maintenance required now is just too continuous, too complex. So legal and admin service providers are all moving to retainer-based models. And clients need to budget for, I'd say, a 15 to 20% premium on their standard admin fees just to cover the DORA and ESG overhead. Compliance is now a high-cost utility.
So for a practitioner, a lawyer, what does all this mean for drafting contracts right now?
The report points to 3 absolutely critical negotiation points that should be top of mind for everyone. First is the restoration indemnity from Circular 24856. The investment manager has to argue for carving out this regulatory obligation of restoration from the traditional commercial liability caps.
The argument being that it's a legal requirement, not a commercial negotiation point.
Precisely. It's imposed by law, so it shouldn't be limited by a cap based on a multiple of your fees. Second, the DORA unlimited access, right? For any function you deem critical core NAV calculation, for example, you have to insist on the right to audit your ICT provider, your cloud vendor.
And they often resist that.
They do. So the compromise is you accept pooled audits for non-critical services, but you reserve a full, robust right to audit for the critical functions. You can't compromise on your core infrastructure. And third, the ESG data warranty. Since you now have to prove that 80% alignment, you need specific representations and warranties from your data vendors on the accuracy of their taxonomy data.
Yeah. Which they probably don't want to give.
No, they'll rarely give an absolute guarantee. So the best commercial outcome is usually a best commercially reasonable efforts clause, but combined with very strong termination rights if the data quality drops below a certain level.
That's a very practical roadmap. So to wrap up, if there's one word to define this 2024-2025 period, it seems to be resilience. Luxembourg is clearly trying to move from being just a booking center to being a fortress of competence. In a world the regulator calls unreliable, Luxembourg is trying to offer a predictability premium. It's acting as the EU's regulatory laboratory, pioneering blockchain laws long before MiCA was even established.
And that competence moat is the key strategic asset now. The CSSF is investing in itself. Nearly 1,000 agents, over 22,000 hours of training last year. The whole value proposition of Luxembourg today is that the regulator is sophisticated enough to understand, to approve, and to properly supervise these incredibly complex products that I just get rejected elsewhere because of a lack of expertise. That regulatory sophistication, that is the essential product that's being exported.
This podcast is a collaborative and free resource that improves continually, so your comments or requests for new topics are highly welcome, especially on YouTube. We want to be a helpful strength for everyone working in the Luxembourg Financial Center at all levels. We are often asked how you can help us. Well, a great way to help is by subscribing to our shows on all major podcast platforms, including Spotify, as well as on Apple Podcasts, where a 5-star rating would really help us. You can also like our videos and subscribe to our YouTube channels, Rigor Media, and Bertrand Mariox blog. We also invite you to follow or connect with Bertrand Mario on LinkedIn and to like and comment on our posts there. All relevant links will be available in the show notes. It was the Luxembourg Fundcast for you today. This podcast includes content created using artificial intelligence tools. All information is for general purposes only and does not constitute financial, investment, legal, or regulatory advice. Listeners should verify information independently and consult qualified professionals for personalized guidance.